All right, before we get into Job Seekers Wednesday, first let's take a look at how the markets have moved today. Food services firm Bidcorp reported a 12.5% increase in full-year earnings earlier today, supported by a positive trading performance in its development markets. Now, Bidcorp, which operates in Europe, the United Kingdom, and Australasia and emerging markets, recorded headline earnings that rose 7.7%. Now, headline earnings is the main profit gauge in South Africa and strips out certain one-off items. Bidcorp supply hotels, restaurant, industrial, caterers. And joining me now to talk through this and other stories, I'm joined in studio by Tsitsi Hatendi-Matika from Absa's Wealth and Investment Unit. Tsitsi, it's good to see you.
Good to see you too.
Well, this is, of course, a good story in terms of headline earnings per share, 12.5%. That's what we are looking at. What is driving this?
Absolutely. So they've had good revenue growth, and also their gross margins have been really assisted by how they've cut costs and really maximized on Australia in particular, where they've seen growth. And they've also said they look to put more into Australia, which would be good for them. It's been a tough market for them, and markets in general have been tough, and weak economic growth and inflationary pressures have been coming against them. But the management team managed to focus and get past the headwinds.
Well, they're looking at growth in Australia, which also indicates that they are now looking at the higher margin companies and no longer focusing on the lower margins. How did they navigate the cost pressures? Labor, there's energy, and there's fuel. These are issues that they had to deal with.
Yes, they talked about that. And also, I mean, Australia has had their turmoil. So similar to South Africa, they've seen quite a tough economic environment, but the management team had a focused strategy. And as you said, they really focused on those things that were key, particularly the labor side of it, and it's worked well for them.
And of course, the UK contract distribution business for this company is also up for sale.
Yes. So there was a bid initially, and that's been pulled, but they are still focused on getting rid of that business, and that will definitely help with the numbers going forward.
In terms of the Europe part of their business, speaking of some wage pressures there.
Yes. So it's been tough within the European markets, and as you said, there are wage pressures there. But I think again, management is quite focused on their growth strategy, and they will get past the headwinds.
And let's look at Dis-Chem as well, improving in terms of cash flow. That's been good.
So Dis-Chem had quite an interesting result, particularly looking at the fact that they have an unmatched offering, and they've talked about their great customer service, and they are trying to use technology to their advantage. They had a bit of a tough time with the strike that happened, but that ended earlier on this year. So at least that's out of the numbers, and that was in the first half of the year. So H2 might look much better, but the result even then was still a good result. It's fairly decent on the day in terms of how it's responded to that, so it's been a good result for them.
Right. Let's look at the environment in which they've had to actually report this. There are some strikes which they had to deal with, and they were decentralizing the storage of their stock as well.
Yes. So I think the strike was quite problematic for them, and this meant that they had to have high stock levels in order to counter that, and for people not to see the impact of the strike. So going forward, they also have to now manage the stock levels, which is it's a big task, but they did weather the storm. And for those people who didn't even know about it, some people missed the strike completely, right? So management did a very good job of that.
What does this mean then in terms of their working capital and in terms of them going to borrow for working capital? Because I think it's something that they were quite worried about.
Yes, they're quite worried about that, and they've talked about trying to free their cash flows in order for working capital to look much better. So going forward, the cash position is quite a big focus for management, and to ensure that that looks healthy.
And what are they looking at investing that money in? Are they looking at expansion?
So I haven't looked at the detail in terms of how much expansion they are looking into, but they have increased their stores. And I think there is a bit of room for bigger entities such as a Dis-Chem, because a lot of the little pharmacies and the family pharmacies that we used to see have closed. So the pressures have been quite intense on those little mom and pop stores that couldn't survive this economic climate. So I think for a Dis-Chem or a Clicks, that would be quite beneficial.
Now, looking at an entity like Dis-Chem in this current economic climate where we are really looking at growth of below 2%, 1% if at that. What is it that they need to be looking at right now in terms of whether they do go to lend for their expansion or whether they actually use the resources that they've managed to gain out of these sales?
So I think a key focus for an entity like a Dis-Chem is cost containment. So the cost pressures are going to continue to come against them, and revenue generation is constrained. So I think cost pressures will be the key thing, and again focusing on technology and how to maximize on that. So you'll find pharmacies such as Morningside Pharmacy have robots now doing some of the work for them. So it's things like that where the competition is getting savvier, and you need to maximize on how best to counter that.
And what does this tell us about the retail space in general, not just looking at Dis-Chem?
It's been very tough in the retail space, and we've seen that a lot of the retailers have cut costs significantly, and one starts to worry that they'll cut to the bone, right? And it's also been tough for the consumer. So the pressures on the consumer are intense. So one needs to make sure that the offering is quite a wide offering that allows the consumer to continuously come back. Because if your offering isn't wide enough, the consumer, at some point looks for alternatives.